It happened when the world was looking the other way. In the final days of the calendar year, while the financial press was distracted by holiday retail numbers and the public was busy with family traditions, a silent alarm tripped inside the plumbing of the global financial system. This was not a loud crash on the floor of the New York Stock Exchange. There were no sirens on Wall Street. Instead, the signal appeared as a single, cold entry on the balance sheet of the Federal Reserve. $17 billion. To the uninitiated, $17 billion sounds like a rounding error in a world of multi-trillion-dollar deficits. But in the world of central banking, the context of a loan is more important than its size. This was not a planned operation. This was emergency liquidity drawn from the discount window, a place banks only go when the private market has slammed the door in their face and the timing was impossible to ignore. This massive grab for cash occurred exactly as the price of silver was teleporting through the ceiling, punching into the upper $70 range and threatening to break the decades-long dominance of the bullion banks. For the men who manage global capital, this was the moment the mask slipped. You see, the financial system is built on the assumption of infinite liquidity. We are told that markets are efficient and that banks are always in control of their risk. But $17 billion in emergency funding says otherwise. It tells us that someone, somewhere, reached the end of their rope. It suggests that a major institution was facing a margin call so violent that they had to pawn their best collateral to the government just to survive the night. The mainstream narrative will tell you this was routine year-end window dressing. They will use technical jargon like seasonal funding pressures or regulatory compliance to make you yawn and look away. But you are here because you know that routine operations do not happen at 3 in the morning during the thinnest trading window of the year. Routine operations do not coincide with a historic squeeze in a strategic metal that the banking elite has spent 40 years trying to suppress. What we are witnessing is the first stage of a structural self-destruction. The banks have built a massive inverted pyramid of paper promises, betting that you will never demand the real asset. They have sold thousands of ounces of silver that do not exist in any vault, using cheap credit to keep the price suppressed. But now, the cost of that credit is rising, and the demand for the real metal is exploding. The $17 billion bailout is the fingerprint of a system that has run out of exits. The short position is no longer a profitable trade for the banks. It has become a hungry beast that is starting to eat its masters alive. This is not just about a move in a commodity price. This is about the moment the paper illusion fails, and the world is forced to face the brutal reality of finite resources. To understand why a $17 billion loan was necessary, we must first understand the architecture of the lie. Most investors believe that when they buy silver, they are purchasing a piece of the earth, a tangible metal with industrial utility and monetary history. But in the institutional world, silver is not a metal. It is a mathematical abstraction. The global silver market is dominated by the paper trade, a vast network of futures contracts, exchange-traded funds, and unallocated accounts that trade hundreds of times the volume of the actual metal pulled from the ground. This is what we call a fractional reserve theater. For every 1 ounce of physical silver sitting in a registered vault in London or New York, there are potentially hundreds of digital claims against it. The bullion banks, acting as the primary market makers, thrive in this environment. They sell these paper promises to pension funds, retail investors, and hedge guards, pocketing fees, and using their massive balance sheets to keep the price within a predictable range. As long as everyone is happy to settle their trades in currency, the music keeps playing. The banks can print infinite paper silver to meet any surge in demand, effectively neutralizing the natural laws of scarcity. However, this system relies on one critical pillar, the unquestioned belief that cash is a perfect substitute for metal. The banks operate on the assumption that only a tiny fraction of contract holders will ever stand for delivery. They have turned silver into a credit instrument. When you buy a silver contract from a major bank, you are not owning a commodity. You are extending a loan to that bank, betting that they will be able to pay you the price difference when you close your position. This allows the banks to build massive short positions, effectively betting against the very asset they provide to the market. For decades, this strategy was considered risk-free. By flooding the market with paper supply whenever the price threatened to break out, the banks could trigger stop-loss orders and scare away speculators. They created a self-fulfilling prophecy where silver was always viewed as a volatile and underperforming asset. This suppression was not just about profit. It was about protecting the credibility of the fiat currency system. If silver, the traditional money of the common man, were allowed to reflect its true value against a devaluing dollar, the entire illusion of central bank stability would begin to crumble. But the weakness of an inverted pyramid is that it requires perfect conditions to remain upright. The banks need cheap funding, low volatility, and a compliant public. In the current environment, all three of those conditions have vanished. The cost of carrying these massive short positions has exploded as interest rates moved higher. More importantly, The world is starting to realize that a paper promise is not the same thing as a silver bar. When the demand shifts from digital digits to physical delivery, the fractional reserve system faces a lethal bottleneck. The $17 billion provided by the Federal Reserve was the grease needed to keep the wheels of this paper machine from seizing up entirely. It was a desperate attempt to maintain the illusion for one more day, even as the reality of the physical world began to break through the screen. In the world of high finance, price is a signal, but margin is the law. To understand the $17 billion emergency, we have to look at the cold, hard arithmetic of the futures market. When a bullion bank enters a short position on silver, they are not just making a prediction, they are entering a binding legal contract. They are promising to deliver metal at a specific price at a specific time. To ensure they can fulfill this promise, the clearinghouse requires them to post collateral, known as margin. This is the skin in the game that keeps the system from collapsing if one party fails. The trap is built into the way this margin is calculated. It is not a fixed cost. It is a dynamic, living requirement that breathes with the volatility of the market. When silver was trading at $25, the margin requirements were manageable. The banks could comfortably hold their short positions using their existing cash reserves and treasury bonds. But as silver began its vertical ascent towards $77, the math shifted from routine to ruinous. Every $1 move higher in the price of silver represents an immediate, liquid loss for the short seller. Let us run the numbers to see the scale of this disaster. A single standard silver futures contract represents 5,000 ounces of metal. If a group of commercial banks is short 10,000 contracts, which is a conservative estimate for the dominant players, they are responsible for 50 million ounces of exposure. In this scenario, a $1 move against them requires an immediate $50 million in additional margin to be posted to the clearinghouse. When silver jumps $5 in a single trading session, that requirement swells to $250 million. When the move is sustained and goes into the double digits, we are no longer talking about millions. We are talking about billions of dollars in cash that must be produced instantly. This is the moment of the margin call trap. The clearinghouse does not care about a bank's long-term reputation or their complex accounting hedges. They do not wait for the market to cool down or for the bank to sell other assets. They demand the cash now, often within hours, or they will begin to forcibly liquidate the bank's positions. Forced liquidation is the ultimate nightmare for a short seller because it requires them to buy back their silver contracts at any price available, which only pushes the price higher and accelerates the losses. It is a feedback loop of financial destruction. The $17 billion draw from the Fed window tells us that the banks were staring into the abyss of this very loop. They reached a point where their internal cash was exhausted, and the private repo market, where banks usually borrow from each other, was likely charging a premium because everyone could smell the blood in the water. By tapping the Fed, the banks were able to post the necessary margin without being forced to close their shorts and trigger a total market meltdown. But this is not a victory. It is a stay of execution. The margin call trap has not been dismantled. It has only been funded by the central bank. The banks are now holding a tiger by the tail, and the cost of keeping their grip is growing more expensive with every tick of the clock. The term bailout is a heavy word in American history. It carries the weight of 2008 and the bitter memory of public funds being used to erase private mistakes. This is why the Federal Reserve and the major banks prefer the term liquidity provision. It sounds technical, boring, and necessary. But when $17 billion moves from the central bank to private institutions through the discount window, we must call it what it actually is: a shadow intervention designed to prevent a systemic heart attack. To understand the gravity of this move, you must understand what the discount window represents. In the hierarchy of banking, the discount window is the lender of last resort. It is the financial equivalent of a hospital emergency room. Under normal conditions, healthy banks borrow from each other in the private repo market. They trade cash for collateral at market rates because they trust each other's solvency. When a bank bypasses its peers and goes directly to the Fed, it is a public admission that the private market has stopped trusting them. It means the other banks looked at the silver exposure on their balance sheet and decided that the risk was too high to lend against. The timing of this $17 billion draw is the smoking gun. It did not happen during a banking crisis or a global recession. It happened during a quiet window when the only thing exploding was the price of silver. This tells us that the stress was not general, it was specific. The Fed intervened because the alternative was a cascading failure. If a major bullion bank had failed to meet its margin obligations at the clearinghouse, it would have triggered a cross-default across the entire derivatives complex. Every interest rate swap, every currency hedge, and every commodity contract linked to that bank would have been frozen. By providing this $17 billion, the Fed acted as the ultimate backstop for the silver short. They allowed the banks to pledge their devaluing treasury bonds at par value to receive immediate cash. This is a crucial distinction. In the real world, if you have an asset that has lost value, you cannot borrow its original price against it. But for the banks, the Fed created a special reality where losses do not matter as long as you need liquidity to keep a short position alive. This is the socialization of risk in its purest form. But there's a darker side to this intervention. Every dollar created by the Fed to fund these emergency loans is a dollar that dilutes the existing supply. The Fed is effectively printing money to ensure that the price of a hard asset remains suppressed. They are sacrificing the purchasing power of the currency to protect the integrity of the banking plumbing. This creates a dangerous precedent. It tells the market that the banks can never truly lose a trade, no matter how reckless their leverage. However, this shadow intervention also reveals the Fed's greatest fear. They are not worried about the price of silver hitting $80 or $100. They are worried that the process of silver finding its true value will break the very banks that represent the foundation of the dollar system. The $17 billion was a desperate attempt to buy time, but in the process, the Fed has become a silent partner in the most dangerous short position in history. History does not repeat itself, but it often rhymes, especially in the silver market. To understand the desperation behind a $17 billion liquidity injection, we must look back to the year 1980. This was the year of the legendary silver squeeze orchestrated by the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt were not central bankers. They were billionaire oilmen who understood a simple truth. Inflation was eroding the dollar, and silver was the ultimate hedge. They began accumulating physical metal and long futures contracts on a scale the world had never seen. As they took delivery of millions of ounces, the price of silver skyrocketed from $6 to nearly $50 in less than a year. The bullion banks and the established financial elite were caught in a lethal short squeeze, much like the one we are witnessing today. But back then, the system did not use a $17 billion Fed loan to solve the problem. Instead, they changed the rules of the game midstream. The exchanges, under immense pressure from the banking establishment, implemented Silver Rule 7. They restricted trading to liquidation only, meaning you could sell your silver, but you could not buy more. They hiked margin requirements to impossible levels, forcing the Hunt brothers into a liquidity crunch. On what became known as Silver Thursday, the market collapsed, not because there was too much silver, but because the system chose to protect the shorts by destroying the longs. The parallels to our current situation are chilling. Just as in 1980, we see a massive disconnect between the available physical supply and the mountain of paper claims. But there is a fundamental difference today that makes the $17 billion bailout even more significant. In 1980, the United States was the world's undisputed economic superpower with relatively low debt. Today, the system is burdened by $34 trillion of national debt and a banking sector that is far more interconnected and fragile. In the past, the system could break a corner in the market by changing the rules or raising rates. Today, they cannot afford to raise rates high enough to kill the move without bankrupting the government. And they cannot simply change the rules without signaling to the entire world, including the BRICS nations and sovereign wealth funds, that the American markets are a rigged game. This is why the Fed had to step in quietly. The $17 billion is a modern, digital version of the rule changes from 1980. It is an attempt to achieve the same result, protecting the bullion banks without the public outcry of a market shutdown. By looking at history, we see that every time the silver market threatens to expose the weakness of the dollar, the establishment reacts with extreme measures. The Hunt brothers were broken by regulation. Today's market participants are being fought with inflationary liquidity. But history also teaches us that you can only suppress reality for so long. Eventually, the weight of the physical demand overcomes the maneuvers of the paper architects. The $17 billion may have delayed the reckoning, but as any student of history knows, the larger the suppression, the more violent the eventual explosion. To the average observer, $17 billion sounds like an enormous sum of money. But in the context of the global financial plumbing, it is more like a single bucket of water thrown into a dry well. To understand why this money was needed, we have to look into the dark corners of the financial system known as the shadow banking sector. This is where the liquidity black hole resides. Modern banks do not operate on cash. They operate on collateral. And the most important collateral in the world is the United States Treasury bond. Under normal circumstances, a bank takes a treasury bond and uses it as collateral to borrow cash in the repo market. They then take that cash and fund their operations, including their massive short positions in silver. This is a seamless, circular process. But a liquidity black hole forms when the value of the collateral drops or when the risk of the trade becomes too high. When silver began its vertical move, the banks found themselves in a dual crisis. Not only did they need more cash for margin calls, but the very bonds they were using as collateral were losing value due to rising interest rates. This created a vacuum. The private market looked at the balance sheets of these bullion banks and saw a terrifying mismatch. They saw institutions holding billions of dollars in underwater silver shorts and billions of dollars in devaluing bonds. In finance, when the smell of fear enters the room, liquidity vanishes. Other banks stopped lending. The repo market froze for these specific institutions. This is the black hole, a state where no amount of private capital is willing to bridge the gap. The $17 billion from the Fed was an attempt to fill this void. But here is the problem that most people miss. Liquidity is not a permanent fix. It is a loan that must be rolled over or repaid. By tapping the Fed, the banks have admitted that they are no longer self-sustaining. They have moved from the private market to the public life support system. This creates a dangerous dependency. If the price of silver continues to rise, or even if it just stays at these elevated levels, the banks will need more cash tomorrow, and the day after that. Furthermore, this liquidity does not stay in the silver market. It leaks out into the broader economy. When the Fed provides $17 billion to save a bank's short position, that money eventually finds its way into the money supply. This increases the total number of dollars chasing a finite amount of goods and services, which is the very definition of inflation. The irony is total. The system is printing money to protect a short position against an asset that people buy to protect themselves from printing money. The $17 billion is not a solution. It is a signal that the black hole is growing, and the system is having to work harder and harder just to stay in the same place. The most dangerous moment for any magician is when the audience stops looking at the hat and starts looking at the sleeves. For the global silver market, that moment has arrived. While the Federal Reserve can print $17 billion in a heartbeat, it cannot print a single ounce of silver. This is the fundamental physical disconnect that is now tearing the system apart. We are moving from a world of price discovery to a world of availability discovery. To understand the scale of this problem, we must look at the inventory levels of the major exchanges, specifically the COMEX in New York and the London Bullion Market Association. For the last several years, these vaults have been bleeding metal. We have seen hundreds of millions of ounces move from registered status, which is available for delivery, to eligible status, which is held by private owners who have no intention of selling. When you look at the data, the amount of silver actually available to settle the massive mountain of paper contracts is at historic lows. This is why the $17 billion bailout is so significant. It proves that the banks are trying to solve a physical shortage with digital currency. In a normal market, when an asset becomes scarce, the price rises until new supply is brought to the market or demand decreases. But silver is not a normal market. It is an industrial essential for the green energy transition, electronics, and medical technology. This demand is not discretionary. A solar panel manufacturer cannot simply decide not to use silver because the price went up. They must have the metal to stay in business. When industrial users and sovereign nations realize that the banks are leaning on the Fed for liquidity, they stop trusting the paper price on the screen. They begin to fear that the metal will not be there when they need it. This leads to a phenomenon called physical hoarding. Instead of rolling their contracts forward, big buyers start demanding physical delivery. They want the bars in their own vaults, not a digital receipt from a bank that is currently on life support. This is where the paper illusion shatters. If only 10% of the contract holders on the COMEX demanded delivery tomorrow, the exchange would likely have to declare force majeure. They would settle the contracts in cash at the current price, effectively admitting that they do not have the metal. But settling in cash does not help a manufacturer build a product. It only confirms that the paper market is a lie. The $17 billion provided the banks with the cash to pay off some of these obligations, but it did nothing to refill the vaults. As the physical supply continues to tighten, the disconnect between the paper price and the physical premium will only widen. We are approaching a day where the official price of silver might be $80, but you cannot find a single ounce to buy for less than $120. That is the sound of a system breaking. Every time a central bank intervenes to save a financial institution from a bad bet, an invisible tax is levied against every person who holds that currency. The $17 billion injection to stabilize the silver market is more than just a technical adjustment. It is an assault on the credibility of the United States dollar. When the public realizes that the Federal Reserve is willing to expand the money supply to protect banks from the consequences of their own leverage, the fundamental social contract of money begins to dissolve. Currency credibility rests on the belief that the money is a stable store of value and that the rules of the market apply equally to everyone. However, the silver bailout broadcasts the opposite message. It tells the world that the price of hard assets is not determined by supply and demand, but by the needs of the banking elite. If a rise in silver prices threatens a bank, the Fed will simply create more currency to bridge the gap. This creates a moral hazard of epic proportions. It encourages banks to take even larger risks, knowing that they are too big to fail and too interconnected to be allowed to lose. This dynamic is especially dangerous in the current global climate. We are living through an era of de-dollarization, where nations from Asia to the Middle East are looking for alternatives to the dollar-centric system. They are watching these interventions closely. When they see the Fed printing money to save silver shorts, they do not see a stable superpower. They see a system that is trapped. They see a currency that is being sacrificed to preserve a broken financial architecture. This accelerates the shift toward gold, silver, and other tangible assets as the only reliable forms of reserve capital. Furthermore, this intervention transforms private risk into systemic consequence. The losses that should have been absorbed by the shareholders and bondholders of the bullion banks are instead being socialized. Through the mechanism of inflation, the cost of the silver bailout is paid for by the person at the grocery store and the retiree on a fixed income. As the money supply grows to fund these emergency windows, the purchasing power of the dollar shrinks. This is the ultimate irony. The very banks that are shorting silver to keep the dollar looking strong are the ones forcing the Fed to print the dollars that make it weak. We must understand that trust is the only thing backing a modern fiat currency. Unlike gold or silver, the dollar has no intrinsic value. It works because people believe it will be accepted tomorrow. But belief is fragile. It is built on decades of stability and destroyed by moments of desperation. The $17 billion draw is a public confession of desperation. It shows that the system can no longer survive an honest price in the commodities market. As this realization spreads, the rush out of paper and into physical assets will transition from a trickle to a flood. The Fed may have saved the banks for now, but in doing so, they have put the long-term survival of the dollar at risk. The $17 billion emergency loan is not just a domestic banking story. In the grand chessboard of global power, it is a signal of structural vulnerability that our competitors have been waiting for. We are no longer living in the era of a unipolar financial world. As the Federal Reserve moves to protect the bullion banks and their paper short positions, a rival bloc of nations led by the expanded BRICS alliance is moving in the opposite direction. They are shifting from a system based on debt and digital promises to one anchored in physical commodities and resource nationalism. To understand the geopolitical stakes, look at the behavior of central banks in the East. Over the past several years, and accelerating into 2025, nations like China, India, and Russia have not only been record buyers of gold, but they have also begun to recognize silver as a strategic asset. They have watched the Western paper markets suppress the price of silver for decades, and they have reached a simple conclusion. If the West is selling paper claims for cheap, the East will buy the physical metal until the vaults are empty. This is not a speculative trade. It is a long-term strategic reorientation of their national reserves. The BRICS nations now represent 45% of the world's population and a massive share of global industrial production. They understand that silver is the indispensable metal of the 21st century. It is the backbone of the solar revolution, the nervous system of advanced electronics, and a critical component in the defense industry. By allowing the price to be suppressed through bank leverage, the Western financial system has effectively subsidized the industrialization of its rivals. But that subsidy is ending. The $17 billion bailout shows that the banks can no longer maintain the suppression without direct intervention from the Fed. We are now seeing the emergence of the BRICS mineral exchange, a direct challenge to the London and New York dominance. These nations are looking to create a transparent pricing mechanism that reflects physical demand rather than paper leverage. They are moving toward a multipolar currency system where trade is settled in local currencies or even commodity-backed units of account. When an international buyer sees that a major American bank needs a $17 billion lifeline because silver rose in price, that buyer loses faith in the dollar as a neutral reserve asset. They see a system that is rigged to protect its own plumbing at the expense of everyone else. This geopolitical shift creates a permanent floor for the price of silver. Every time the banks try to hammer the price down with paper contracts, sovereign buyers in the East step in to absorb the physical supply. They are effectively arbitraging the credibility of the Federal Reserve. As the West prints more currency to save its banks, the East accumulates more metal to secure its future. The $17 billion may have saved a bank in Wall Street today, but it has accelerated the transition toward a world where the rules of finance are written by those who hold the atoms, not those who print the bits. The silver short is no longer just a financial liability. It has become a geopolitical trap. We have traveled from a quiet holiday window to the deep plumbing of the Federal Reserve, and finally to the grand stage of global geopolitics. What we have uncovered is not just a story about a $17 billion loan. It is a story about the end of an era. The era of paper dominance is colliding with the era of physical reality. The silver bailout of 2025 will be remembered as the moment the system admitted that it could no longer survive the truth. When a bank needs a central bank lifeline to survive a move in a strategic metal, the game has fundamentally changed. We must understand that this is not a temporary spike or a passing anomaly. It is a structural repricing. For 40 years, the world operated under the assumption that there was an infinite supply of silver because there was an infinite supply of paper. That assumption is now dead. The $17 billion was a desperate attempt to resurrect it, but you cannot fix a shortage of atoms with a surplus of ink. As the margin calls continue and the physical demand intensifies, the banks will be forced to make a choice. Either they continue to tap the Fed until the dollar loses all meaning, or they allow the price of silver to reach its natural equilibrium. What does that equilibrium look like? It looks like a world where silver is no longer a neglected commodity, but a core component of global wealth. We are moving toward a reality where the silver-to-gold ratio returns to its historical norms and where the price reflects its dual role as both an industrial necessity and a monetary refuge. This repricing will be violent because it has been suppressed for so long. It will not be a smooth climb. It will be a series of jumps, separated by moments of forced liquidity and government intervention. For the investor, the message is clear. The presence of a central bank bailout is the ultimate confirmation of value. If the system is willing to risk its credibility to keep you from owning an asset at a fair price, then that asset is exactly what you should own. The $17 billion tells us that the banks are fragile and that the physical metal is powerful. It tells us that the paper markets are a hall of mirrors and that the only way to find the exit is to hold the tangible asset in your own hands. In the final analysis, the banks did not just self-destruct their short. They self-destructed the belief system that allowed them to control the market. Trust is the most expensive thing in the world to replace, and it has been spent. As the world transitions from the illusion of digital wealth to the certainty of physical possession, those who understand the signal of the $17 billion bailout will be the ones who are prepared for what comes next. The short is over. The repricing has begun. And in a world of infinite currency and finite things, the math always wins.